You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO. This Week in Futures Options, the program where we break down all the things happening on the other side of the fence, the futures options side of the fence. Maybe we'll talk some metals, maybe we'll talk some ag, some energy, some equities. You never know what's going to make it on the show. That's why you have to tune in every week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which so many of you have been just feasting of late. Glad to see so many new listeners discovering the network out there these days. We always love the influx of new folks. Keep that influx coming, particularly in these troubled times. You know where to go. Wherever you're listening to this program, could be Apple Podcasts, could be Live, could be Google Podcast, could be Spotify, wherever you get it, via our social media. You know, make sure you leave comments, make sure you leave reviews so other folks can continue to discover this content in these troubled times. And, of course, keep those questions coming. We do love to hear from you guys. And speaking of hearing from people, usually this is where I turn to my compatriot, my partner in crime, Mr. Sean Smith, for the Managing Director of Derivatives Licensing over there at FTSE Russell, holding down the FTSE Russell hot seat. But he is on a well-deserved vacation this week, even though I think he was a little concerned about traveling to said destination. That's a little bit more challenging these days than it used to be. So luckily, we have a great guest joining me to do double duty, hold down the CME Group hot seat and the FTSE Russell hot seat. Luckily, I think he's up to the challenge. He's Mr. Dan GRAMZA, the futures and options educator extraordinaire, and also the president over there at GRAMZA Capital Management and DMG Advisors. Dan, welcome to the TWIFO program, sir.
Well, thank you very much, Mark. I'm really excited about being with you today and exploring these exciting markets. A lot going on and a lot for us to chew on today.
There is a lot for us to chew on. You know, it's funny. This network has been running for over 13 years, yet somehow, Dan, this is your first appearance. I don't know how that happened, but c'est la vie. Strange things are afoot. So if there are some folks out there who aren't aware of your decades of education and work on the futures and futures options side, why don't you go ahead and give our audience a brief overview of what it is you do in your background there, Dan?
Well, background-wise, I started with stock options. I was at SIBO. I was actually going to clear first stops, and I was going through their program of becoming a market maker. And I thought delta neutral spreads were the ultimate thing that I wanted to do. And I realized even though I insulated myself to price, I had a new friend, volatility. So I thought I should look at price again. And those guys across the street at the Board of Trade, those guys looked at all kinds of charts. So I decided to get a seat actually in the Chicago Rice and Cotton Exchange to get exposure to the order flow on the floor. I didn't really so much care about trading in the pit as much as I wanted to see the function of the market. And what that led me to is how I define the markets from a technical point of view. And the CME actually, this back in the late 80s, actually contacted me about teaching a course for the floor traders. I did that, and it went well, and they said, could you open to the public? I said, sure. 2 traders from the RBC, Royal Bank of Canada, came down out of Toronto, and they went back. They're doing better. Boss says, what are you doing? Learned it from a guy in Chicago, and so they said, come on up here. So for 7 years, I taught all the new hires at RBC. And as you know, Mark, in any industry, everybody kind of knows everybody. And they referred me to a group that was looking for someone to teach technical strategies in London. And then they told somebody in Sweden and Helsinki. And I've had the opportunity to work with over 450 institutions, over 36 different countries, over 39 different exchanges through this word of mouth network, which surprises the heck out of me. But it's just through the kindness of others. I've had the opportunity to see a variety of institutions, a variety of different marketplaces. And I usually circle the globe a couple times a year, but it's not happening this year. It's the first time I haven't gone to another country at least 4 or 5 times by this time of year. But so I trade. I'm 80% exposed to the market right now. And I also have an opportunity to share ideas with other people. Oh, and I do a free daily video at dangramza.com. Just to recap on some of the futures markets that are moving. So that's kind of an overview.
I like that, Dan. And it all started from meeting your new friend, Volatility. Who'd have thought where that new friend would have taken you, Dan?
Do you know something? If it wasn't options redirecting some of my thinking, you're correct.
It can be a friend. It could be an interesting friend sometimes, but it could be a friend nonetheless. This is usually, Dan, where I turn the tables over to Sean. I ask him to pick where we begin our movers and shakers. We're going to do something a little bit different this week, though, because we have some new numbers to get to first. These are out of our friends over there at FIA, a.k.a. the Futures Industry Association, a.k.a. the folks who kind of crunch not just the U.S. listeners, but the global derivatives volume. Some interesting trends afoot over here now that the numbers are in for the first half of 2020. You know, if you've been listening to our programs like the Option Block and others, we break down the U.S. domestic options numbers. And it's interesting to see if that trend is following suit. June was a record month. Let's see what's going on here globally. And according to the FIA, global futures and options, so they're combining all derivatives, futures and options listeners, grew by 32%. This was in the first half of this year to almost 22 billion, 21.9 billion contracts. That's compared, of course, to the year before. So 32% compared to Q1 of 2019. The second quarter was also record-setting. If you take the first quarter out of the equation, the second quarter was pretty active. Actually, I'm sorry, that 21.9 billion is the first half. That's the first half of the year. The first quarter was 11.41 billion. The second quarter just edged out ever so slightly by the first quarter, 10.46 billion. So still a record, up nearly 22% from Q2 of last year. Q2 was the highest volume quarter on record in history, except for Q1. So Q1 and Q2 so far, a very active, very high volume quarters. OI, so total OI. This is kind of interesting and surprising to me. I'd be curious to get your thoughts on this, Dan. You think for all this volume we're seeing, you think OI would be off the charts, yet that's not the case. Total OI at the end of June was 915 million contracts. That's up only 3.4% from June of that year. So that clearly a lot of churn and burn over that first half of the year. Not a lot of extended positioning going on out there. Some other interesting nuggets, if you want to know which regions were lighting up the tape the most. Asia Pacific had the largest increase in overall trading volume, followed by us here in North America. In terms of percentage, you got Latin America growing the most, twice as much as Europe. Of course, they're starting from a much lower baseline there. In terms of asset classes, what are people actually trading? Well, there's a reason why we talk about equities a lot on this show, because equities are still dominating the tape out there. Equity index futures and options was up 51% compared to the first half of 2019. Single stock, those products rose 34%, and they accounted for, get this, listeners, 59% of the total volume in the first half of this year, and 67% of open interest. So equities dominating the tape out there this year. Rates, not so much. The total number of rates contracts, again, we kind of have the Fed laying out its game plan till 2022, so that kind of muted some interest out there in rates. Total volume for the first half was pretty much unched from last year, and open interest actually down 17%, which is interesting. Other markets of note, precious metals was actually down 3.4%. I'm sure if you factor in this most recent rally, maybe that might be changing. But a lot of interesting stuff. Let's start here, Dan. A lot of interesting nuggets. First off, equities dominating the tape for the first half of the year. And then also what kind of surprised me, I'd be curious if it surprised you as well, huge volume, huge churn and burn out there for Q1 and Q2, but not a lot of change in OI. Does that surprise you as well, Dan?
Well, yes and no, Mark. You're bringing up a really good observation. But what goes through my mind is, let's think about some of this action that we're seeing. If you look at the equity side of the CME book, for example, what we're seeing is a new product line that started this year, and that was the micro futures contracts, or I guess it was last year. We had the micro futures contracts. The volume in that truly has exploded. Let's also talk about what is the time frame for most people who trade futures and options when it comes to the equity market, especially. They're there to speculate. They're there to take that short-term position and try to capture some opportunity, as opposed to a hedger, which is trying to lock in price protection. A speculator is trying to lock in profit. So I think that's one of the reasons why we're seeing the volume increasing, but we're not necessarily seeing the open interest increasing. That hedging activity is still there. So that hasn't dramatically changed. But I think the speculating side has. And the micro futures really has brought in a new community. I got to tell you something, Mark. What I was curious about was when they started this, the micro stock indexes, on the S&P, NASDAQ, Dow, and Russell. Would that scavenge? Would it take away, cannibalize the volume you would see in the mini contract, a contract that's 10 times larger? It didn't happen. So the volumes in the mini contracts continued to increase, and then you have this micro contract volume exploding. And Mark, I think that's because it brought in the equity community that traditionally did not trade those markets. Now the cost of getting in, 1/10 the size of a mini contract. So the cost of entry is lower, the capital requirements, the tick exposure is lower. So it makes it much more palatable, I think, for people to look at the futures market. And so we're seeing it not only in the equities, but if you look at the micro metals, the gold market, for example, or the currency markets, I think that's opened the door for a lot of people that have become aware of maybe there's some opportunities in the futures and the options on futures markets.
Certainly have a good point there about the micro contracts. I never anticipated, I don't think CME did either, that the micro equity futures would explode the way that they have. And yet now they freely admit that they are the most popular, most successful product in the history of the exchange. People are just devouring those, so much so that we're getting options on them soon, which should be interesting out there. We could keep parsing the numbers, but we have to parse more recent numbers here, Dan, in terms of what's lighting up our tapes, what's lighting up the markets this week. So this is usually where I toss it to Sean, let him choose where we're going to start. I will give you the same choice here, Dan. Should we start to the light side this week, aka things that are moving to the upside, which, spoiler alert, is most of them, or should we go to the dark side, Dan? Where should we begin our journey this week?
Well, let's start with the light side. Why not?
Yeah, it's an interesting week. I often say here on the show, it seems like the weeks are very biased in one direction or the other, and this is clearly one of those weeks, listeners. In fact, you have to scramble to find 5 names that are actually down on the week. That's how dominant the green is on the screen. You guys, as always, can see this for yourselves. Play along with the home game. Generate your own reports for the show. CMEgroup.com/TWIFO. TWIO also works, TWIO. Either way, you can do those and generate your own reports for yourselves. If you're playing with the full kit and caboodle over there at Quick Strike Land, the full upgraded software there, then you want to go into the market scans for this, and you can find our reports in the Quick Reports home under the This Week in Options. Just click on that, and you'll see all of our reports there for you. Let's start as Dan's. He's doing a good job impersonating Sean here, picking to the upside. A lot of green to parse here, listeners. First off, we've got, our old friend Lumber was number 1 last week. It was number 1 the last 2 weeks. This week, not so much. It has fallen off a cliff. It's a meager number 23 to the upside now, only up 1.01%. Let's get into the actual top 5, though. Number 5, gold. Good week for gold. I think we're going to talk some metals today, up 5.4%. Number 4, Eurodollars, up 5.75%. Number 3, pretty much all metals the rest of the way, listeners. Number 3, palladium, up 10.5%. Platinum, feeling the lift, up 15.93%. And number 1 with a silver bullet here this week. Yeah, see what I did there, listeners. It's silver, up 18.58%. You know, we talked silver with Uncle Mike on the show last week. I got a feeling we're going to be talking that one again this week. Let's move to the dark side now. Like I said, this was a challenge. We had to do a little bit of digging. So much green, so much out, except for today, of course. Equities and a lot of major markets selling off today. But net on the week, they're still all up pretty strong. Number 5 to the dark side, wheat. This will show you how much we have to dig, listeners. Wheat was off 0.61%. And that makes it all the way to the number 5 on our movers and shakers list. Number 4, lean hogs, off 0.72%. Number 3, corn. It was number 1 with a bullet to the dark side last week. It was off nearly 5% last week. This week off not even a full percent, 0.96% out there. Then we got KC wheat off 1.06%. And live cattle off about 1.5%. Last week it was number 2 off. Number 2 to the upside, up nearly 7%, about 6.7%. So it has fallen a wee bit, but not a ton out there. So Dan, you are our guest. I just kind of broke down our movers and shakers, but I know you have a lot of products you're always analyzing yourself over there at dangramza.com and through your various ventures over there. So I will open the floor up to you. Where should we begin our journey this week, sir?
Well, how about if we start with where we had the metals? You mentioned metals. Shall we start with gold or silver? And even copper is kind of interesting, but
they're all interesting. I happen to have silver up on my screen right now, so why don't we dive in there? I know this one's been of interest to you and a lot of your viewers and subscribers over there of late, Dan. So walk us through what's been lighting up your tape in silver of late, sir.
Well, I think what's interesting about the precious metals in general, silver being one of them, gold the other, is they're what I call excuse markets. They move not because of supply and demand, like if you're looking at crude oil. They move because of perception. of what people perceive it to be. And let's think about where do we look at silver and gold? Well, we think of those as a storehouse of value. People put money in there because they think in bad times that money's still going to be there. If we have high inflation, money has a tendency to go to silver. Well, we don't have high inflation right now. If we have a weaker dollar, money has a tendency to go towards silver and gold. Well, we do have a weaker dollar, and it looks like it could get weaker. So that, I think, is some of the fuel behind this. Also, the perception of uncertainty. One thing about the virus is that it's a hole that we just don't see the bottom of, which makes it kind of scary. Will it end? Yes. When? That's a good question. So I think that uncertainty also is fueling the move that we see here. But that being said, Mark, I think we have to be cautious. You know, has these markets, gold and silver, have they stretched far enough that some people are saying, you know, I want to take some profit? And I think over the next few days, we'll get some clues to that. So, for example, if silver moves down towards 22, we want to look at how it gets there. I use candle charts, but I don't use them in a standard way. It's what I call behavioral candles. It's what you would see on the floor in terms of the broker's hands, in terms of paper. I saw this technique in Tokyo at Bank of America when I was teaching a course on the yield curve, a market profile, a different approach. And part of it was to trade the 30-year Treasury bonds. I go in the dealing room, I walk out, and I see this fellow drawing these candle charts. As many of your viewers know, you know, if it closes above the open, that would be a green body. If it closes below the open, that would be a red body. From my point of view, I think green represents buying, red represents selling. The line you could see on the top represents selling. The line you could see on the bottom represents buying. So my point behind saying that, if we get down near 22, if we trade back towards that range and you start seeing those lines on the bottom where you see green bodies, if we come off, that would imply profit taking, and I would be looking for another push right back up. That uncertainty is still out there. A weaker dollar is still out there. So from that point of view, I'm on the bullish side when it comes to these markets.
Yeah, it's certainly been bullish from an overall underlying, from a volume, just about every perspective you could possibly analyze here in silver this week. It's a bullish week out here, listeners. Of course, you find this heading into the drop down. Go to precious metals, go to silver, and you'll be off to the races. This, of course, our This Week in report, so it goes from Monday through today in terms of what's been lighting it up. And silver, as you mentioned at the top of the show, is up strong. Through Monday to today, it's up nearly 15%, 14.91%, at about 22 double on that front contract. That's going out in about a day, so that's not long for the earth out here, listeners. Vol also up very strong as well. The Vol has nearly doubled out here over the course of just this week, up 21 and a half handles, 28 points on the weekly contract with about 8 days to go. So there's just a lot of vol, a lot of movement. And it sounds like this vol is warranted out here, listeners. It's not like it's a surprise when the underlying moves. People forget. People always think of downside and they conflate that only with volatility. But in reality, movement is movement, and that equates to vol, and we're seeing that out there right now in silver. In terms of where the action was out here, listeners, it was in the September contract. 41% of the paper went up out there so far this week. About 107,000 contracts on the tape so far. That's about 20 plus, almost 20,000 contracts more than we saw this time last week. So a pretty busy week so far for silver out here. And the big contract that was lighting up the tape out here in September, it was the 22 calls. Number one with the bullet, 5,428 of these bad boys. The lion's share going up on Tuesday, 3,261, 1,300 yesterday, and the rest kind of scattered throughout the week. A decent chunk of that opening, but it seems like it's a lot of back and forth, which is not surprising. That's the strike we kind of blew through, and then now Dan's talking about retesting it maybe again to the downside. So as we blow through and flirt around this strike, you're going to see a lot of back and forth churn and burn on a strike like this, and maybe not so much positioning out here. So that's That's not surprising, but kind of interesting nonetheless. And then we also saw number 2, the 24 calls. So maybe a little bit more optimistic, doing about 3,400 contracts. The lion's share also on Tuesday, 1,300 going up there. The rest kind of scattered. A little bit more opening on this strike, which makes sense. It's a little bit farther out of the money. Let's go out to what we're seeing here. Again, for that SEP contract, the vol is now about a 45.5. It's up about 16 points so far this week. So a very volatile week. In terms of skew, let's look here. Interesting. The puts are actually literally unched. They were 9.2% cheap to the at-the-money last week, and they are exactly the same this week. So no action whatsoever on the puts, which is kind of surprising given the fact that we have exploded up the curve. And yet, of course, the calls, interesting as well. The calls were 16.7% rich this week, and then now they're 10.1%. So the calls have come in, and the puts are unched. Not at all what I expected when we're exploding about 3 handles up the skew chart here. But obviously some of those calls, some of that call paper, obviously to the upside 24s, maybe is a little bit of selling paper up there, maybe dumping of some contracts up here. Dan, does that surprise you that we were exploding so much up the chart here in terms of silver this week, and yet the puts are effectively unched from a vol perspective, and the calls have come in pretty aggressively, sir?
Yes, I agree with you. You would expect more of an imbalance with the kind of price action that we've seen. But Mark, maybe that also tells us something about the belief that people have out there right now. It'll be interesting to see what those numbers do, what that skew does tomorrow. I love Fridays because Fridays force people to make a decision. If I'm long silver, do I stay long? Do I take profit and get back in on Monday? Are we going to see a market back off on Friday where we don't see that confidence as we go into the close? Or are we going to see that close near $24, which says they love this silver market? So I think tomorrow's close could give us some insights into that attitude. And the skew, you would think it'd be far more out of balance than what it is right now.
Very strange things afoot. We're going to keep an eye on this one, but we have to keep rolling. Dan, you mentioned another shiny, precious metal out there, which is gold. Gold has been on a bit of the tear, I think to put it mildly, of late. Up for 5 sessions now in a row. They were threatening their highest ever settlement point out here. Let's see. The record intraday is 1923.70. That came on September 6th of 2011, and the record settlement was 1891.90. And we're not quite that far, about 5-6 handles away from that right now, listeners. So threatening new record highs. Dan, what's been lighting up your tape out here in this exploding metal known as silver, sir? Or excuse me, gold.
Well,
gold.
Gold, yeah. Well, they both have similar actions here. The silver market, I think, structurally, from a technical point of view, kind of led the way. It set the tone, and then the afterburners kicked in the gold market, especially over the last 4 sessions. We're seeing those buyers coming into this market. And right now, I think gold looks a little stronger than what we're seeing with silver. Silver, we could back off a little bit. Gold, on the other hand, the attitude here that we're seeing here right now is positive. People are willing to hold on to that position. And again, I think it goes back to the perception. We have those issues, and we had, the jobless claims were 1.4 million. People are saying, oh my gosh, that's worse than last week. But, Mark, we should see high numbers. Our economies are basically still dampened down. But gold, on the other hand, I think reflects that type of attitude, market attitude. So if we see a weaker stock market, look for gold to give us a nice, clean, strong close at the end of the week. Getting above 1,900, I don't think is out of the question.
Let's see what our options are telling us over here. Listeners, coming into showtime, we're seeing gold up about 4.25% here on the week. That's a whopping 75 handle, 76.2 to be precise out here, listeners. And the vol, as you might expect, is up, given that aggressive move to the upside. Gold volatility has been something we've talked about and wrung our hands over here on the show for years now. It's always been kind of a bit of a weird beast. It languished for years to the point where it was so cheap you really didn't want to sell it. But also, gold did move a little bit, so sometimes it could merit buying it. But it was a strange beast. It kind of had its own life to itself for a long time. Now it's starting to get some new life to it as gold is exploding ever higher out here. We're seeing in that front contract it's about a 20.5, but that's going away in about a day. Let's move a little bit farther out. Let's go out to a couple of weeks. We're seeing to the AUG week 1 contract out here. That's got about a 19.5. That's up 6 points so far this week. So an aggressive bid for gold vol. Let's go out here. The most action, it was actually a pretty widely split market here this week. People were trading all over the place. The most active month was Dees and only had 25% of the paper. Usually you see 35, maybe 40% or more to dominate a week. But this week people are trading all over the place. So let's go out to Dees and see what's going on. The Dees vol, by the way, 20.14, so up nearly 4 handles so far on the week. Let's go out to the D skew. Let's see what was lighting it up out here. The puts were 4% cheap to the at the money, so not a lot of love for the puts last week, and they got bid up a little bit. Not much, but a little bit. They're about 2.2% cheap this week. So getting a little bit of a bid to the puts. Not surprising. You're starting to teeter-totter at some pretty oppressive levels to the upside. Doesn't surprise me. Some folks might have a little bit of interest in some puts. What does surprise me, though, is the calls. The calls, we've exploded 75 handles. Again, similar to what we saw in silver. And we're seeing at least the D skew remaining relatively sane, relatively stayed, not really changing so much. It was 8.6% rich to the at the money last week. This week, a paltry 8.8%. So it hasn't really changed at all. We've blown through multiple strikes to the upside, and we're seeing the skew kind of unched. Dan, that's strange to me. Both metals we're seeing very similar and kind of head-scratching skew activity. Does this surprise you in gold as well, Dan?
Yes, it does, because with the rapid movement we have here, you would think that skew would reflect it. It's not. But you also brought up a really good point, Mark, and that was, as we look at the prices right now, as we go out in time, there's nothing unusual there. It also said something about, the volume there, that what are people thinking longer term? And I had someone at an institution I was talking with yesterday, and they're looking further out on the precious metals towards even next year. And so it's kind of an interesting market right now. And you're right on target. It's been, I wouldn't say dead, but very neutral. A market that wanted to go higher but didn't have a reason to do it. Because again, I think this is an excuse market. Give it a reason and we'll get some volatility. And right now, maybe it is the virus. Maybe it is this idea of what they consider, the jobless claims, and the outlook creates that uncertainty, and plus the weaker dollar that could be reflected here. And none of that is really going away. So you would think that this upper pressure that we're seeing would be maintained and that skew would widen. We would look for some more activity there.
Well, people are certainly looking for some activity to the upside here, Dan. Looking at the hot strikes out here, the hot options in gold land over there on CME this week. And it's not even the 1900. Forget 1900. People are already past that, Dan. They're all the way up to 2000. It's the 2000 strike contract, or 2000 call here in Dees that's dominating the tape this week with about 10,700 on the tape so far. The big day today, listeners, 4,000 on the tape today, about almost 4,000 yesterday, so pretty close yesterday as well. And the lion's share of that opening, obviously we don't know about today's paper, but looks like a lot of opening positioning to the upside. If that's not bullish enough for you, also looks like some people piling in out here in Jan to the 2,100 calls, doing about 2,300 of those. So a lot of pretty far upside plays here. So forget about 1,900. We're already beyond that psychologically, it seems like. It looks like all the love is to the upside, even though that skew is troubling me. That surprises me. I'm going to have to dig into that a little bit more and see exactly what is afoot out there. Does that surprise you as well? Listeners, let us know. Hit us up. We do love to hear from you guys. And Dan, as our guest, I will allow you to choose where we go next. I will give you maybe a little bit of guidance. One segment we don't get a chance to talk about a lot here on the show, but I know it's of interest to you, is the FX market. So if you want to hang your hat in FX, sir, pick our poison.
Well, I can tell you there's a few different currencies that I find interesting right now. And I'm sorry, there's one more thought I just had regarding gold. The points that you raised regarding that option activity, which I really like you doing that, it does say something about the attitude of people long term. But it also says something about the potential if we back off, what is going to be their tolerance? How long are they going to hold on to something? And if we back off enough, it's going to put enough pressure there that people may be exiting some of those positions. So I just think it's something to watch. But going back to these currencies, the Swissy or the euro, either one of those, the Swissy really has been waking up here. That's been a lot stronger. The euro has been on a definite uptrend. You know, we're not seeing that paper flowing towards the dollar. It's moving away from it. So those are two markets that I find interesting. Another one that I think is, I would say I'm suspect of it because it's really related to crude oil, is the Canadian dollar. That's also been grinding its way higher here. But I think we have to be very careful there. And then I guess the other ones that we could take a peek at, if you like, is the Canadian dollar or the Aussie dollar, commodity currencies. And those actions really reflect that international trade market. And for Canadian dollar, especially crude oil. You know, we buy more crude oil from Canada than any other country. It's their largest export. So we see it kind of tied together when we look at that particular currency. But we could start with the euro if you like. I'm open to wherever you think you'd want to take this, and we can take a closer look at it.
We'll start in the big dog, which is the euro dollar. Then we'll head out. You know, I don't think we've ever discussed the Loonie on the show here, so maybe we could spend a little time in there as well. But I know we have a lot of FX folks floating around out there in the audience. Again, we don't have a chance. They're not always lighting up the movers and shakers. We don't have a chance to parse them, but sometimes our guests like to pull us into those directions, which is always fun. The Euro USD coming into Showtime up about 1.5% this week. We're at about 1.1625. That's a good strike. I like that out there in that front contract that has less than a day to go out there. The big, and I put big in air quotes because this is another contract that's kind of spread out across a number of months, but the lion's share, almost 30%, about 29.5% of the paper coming out here in this SEP contract that has about 42, almost 43 days to go. The big, let's see, the vol up here, up ever so slightly, up 0.17, so you're talking not a huge volatility bump. It's at about a 6.83 right now. Compare that to what we were just talking about out there in the metals, you know, getting pretty juicy from a vol perspective. So FX has always been kind of notoriously light from a vol perspective, those, you know, Swiss franc debacles notwithstanding. And let's see what's going on out here from a skew perspective. Last week, the puts were about 0.5% cheap to the at the money, so pretty much flat, not much going on in the puts at all. And this week, they are almost literally unched. They're 0.1. So they're pretty much, the put wing is completely flat. Let's see what's going on in the calls. The calls were almost 4% rich to the at the money last week. This week, they're 1.2%. So the puts effectively unched, and the calls have come in out here in this SEP contract. And the big contract out here, the big trade, again, this isn't a decent paper. It's about 78,000 contracts. It does pretty decent paper. The big hot contract out here this week are actually the 1.18 even calls. People like the even money strikes out here. Listen, it's doing about almost 4,000 contracts. 2,100 yesterday, about 1,300 today, and the rest kind of scattered throughout the week. It's slightly opening, so it's like people are going back and forth on that strike, which makes sense. It's not that far out of the money out there. So, Dan, what's been lighting up your tape? What's been catching your eye? And does any of this surprise you out here in our old friend here, the Euro USD, sir?
Well, I think it's behaving in some ways as it should. You know, if you look at the EU in terms of where they are in their process, they, you know, said we're going to have $750 billion stimulus program that's going to be that they have announced, or 750 billion euro program. But And the market really liked that. It said, oh my gosh, they're doing something and they're seeing some positive movement, I think, as a result of that. But we also want to keep in mind that's spread out over a number of years. So right now, it's more the euro is stronger because people are backing away from the dollar. Our virus situation in this country is really a dominant situation when you look at it globally. And I think it's reflected in this currency. So the euro is moving slightly higher because of fundamentals. I think that's part of the driver of what they're doing there economically in their countries. But I think we have to be cautious. It's more of a play against the dollar than it is for the euro, is the way I look at that.
Let's look out here. I guess I said before, we've never touched on the Loonie here on the shows. This is a fun new one for us to parse here. Obviously a little bit lighter options volume, but still a pretty decent week out here. It's done about 15,200 contracts so far. The past week it did about a little bit less than 10,000. So a pretty active week out here for the Loonie dollar. I kind of like your viewpoint as a proxy for CRUDE over here. Dan, come into Showtime. We're seeing that front contract is pretty light, but they're all pretty light right now. Actually, not even 3/4. A little bit shy of 0.75 is where we find ourselves coming in for that Canadian dollar, U.S. dollar spread. The most active contract out here is heading on out to August. That's where we find not quite 25%, almost 24.7% of the paper out here in August. The vol, in case you're wondering out here, is up quite a bit for comparatively at least. It's about a 6 3/4, up about 1 1/3 this week. So that's a pretty big jump for a product that doesn't have a lot of vol to begin with. Skew-wise, last week we were looking at the puts where they were about 1% rich to the at-the-money. This week they're getting richer, 4.4% rich. The calls have done a complete swing, a complete 180 here, listeners. They were 2.1% rich to the at-the-money last week. This week, 2.1% cheap. So calls have come in, puts have gotten bid as we've been rallying out here, which is kind of interesting. Looking at the big print out here, and I put big in air quotes, listeners, because obviously compared to something like Eurodollar, it's pretty small. But for this product here, we got the 0.745 calls, doing a whopping 702 contracts. The half of that, pretty much, 357 going up on Wednesday. The rest kind of scattered throughout the week, and most of that opening. So folks are opening. Again, not surprising. This is pretty much the in-the-money strike now, but right around the at-the-money strike here. Out in August. Dan, any of this surprising you or causing you to scratch your heads? And what's been lighting up your tape as you look at this proxy for the crude market, the Canadian U.S. dollar market, sir?
Well, what's interesting about it is what you said about the skew. I think I mentioned that I'm cautious about this market, and I think that skew reflects that. You know, if you look at where the puts are, that tells something again about some of the price action of the levels that we're at. The at-the-monies, that makes sense to see volume at that level. And today we're seeing a little bit of selling coming into that market. We're also seeing some weaker crude oil prices. So they're kind of acting normal in that regard. And again, the other driver here is it's more of a play against the dollar than it is for the Canadian dollar, so against the U.S. dollar. So we have a couple factors here in play. But I would definitely watch the crude oil if you're going to look at the Canadian dollar. If we're going to see some strength, we want to see a positive close tomorrow. Again, it goes back to the attitude that people have going into the weekend. So I think that close is going to be important. What we don't want to see is the reference that you gave us there, Mark, and that is the 74.50. We don't want to be below that level. It's really a sign of weakness from where we are going into the weekend.
Well, since you mentioned crude, let's get to it. Next up on the docket, I know a name and a product a lot of you guys like to watch, which is, of course, WTI and all things crude oil. Dan, I know this is a popular product for you and your viewers over there as well. What's been lighting up your tape in this insane dance? Maybe before we even get to that, well, let's go back a little bit. Walk us through what you were thinking when the crude oil market fell apart a few months ago and it went negative for the first time ever. And then we'll talk about what we're seeing this week, Dan.
Well, first, I never thought that would happen. And none of the institutions I deal with thought that would happen, including people in the oil industry. It did settle positive, so that was one sign that's a little normal. Here's what was happening there, though, basically, and we still have some remnants of that. We have huge amounts of supply. At that point, we had 160 million barrels of oil being stored in ships around the world. There wasn't even a spot to put it on land. Some of the people I deal with in Europe, they would buy crude oil when it's at those levels, put it in those tankers, and plan to sell it at a later point at higher levels. But you still need that demand side. And with China slowing down at that point, we didn't have that extra demand to soak up supplies. So here's the other thing. If you look at the history of crude oil, for it to be at $10 a barrel, it was only at $10 a barrel, and it went lower than that, obviously, but at $10 a barrel 4 times in the contract's history, 4 times since 1960, if you look at it from that point of view. So it was cheap crude oil. It was a bargain. So institutions really want to load up on that point, but if you're a buyer, where are you going to store it? Things were full. In Cushing, Oklahoma, which is a delivery point, that was really near almost maximum level of storage. So that was one issue. Then we start seeing crude oil prices moving up. Let's talk about some of the fundamental impacts. At $30 a barrel, there are some shale producers that can be profitable at that level. Back in 2008, 2009, when we had that drop, there were a number of companies that had heavy debt loads that went out of business. Right now, we're going to see some of that. If crude oil stays around $40 a barrel, or if it stays near 30, which we're away from now, a number of companies would start going out of business because of their debt load. So they're going to be acquired. What we're also seeing, though, is we're seeing just the creeping up of demand. My feeling is that crude oil for the rest of this year and maybe even part of next year, $40 to $45 a barrel is probably where value is. And I think that's where we are right now. This $40 to $42 a barrel in some ways is a fair price. If you look at Russia, for example, $42 a barrel, they can balance their budget. If you look at Saudi Arabia, they want $60 or $70 a barrel to balance their budget. So there are some drivers in here. The OPEC met, OPEC plus, if you include Russia, met and say, do we keep our production cuts? To give you a point of view, when you hear them saying they're going to cut 9.7 million barrels a day, to put it in a perspective, that represents about 10% of the global production when they go near 10 million barrels. So that's what, and then they're thinking about reducing that. What's also interesting about it is they followed through. OPEC has a terrible history of saying one thing and doing something else. So they all agree in the meeting to cut crude oil, but then they go home and do what they have to do for their economy. So crude oil right now, for this to go sideways, I think makes sense. If you look at the supply situation, which is still heavy, and if you look at the demand situation, which really is not soaking up enough of that excess supply. So I think crude oil is fairly priced right now.
I'm sure a lot of the crude bulls are going to take issue with that, Dan.
Sure.
But what you're saying, it kind of played out week after week now. We've seen this in the WTI options market in particular, and we've discussed it. Every rally that we've seen, particularly now north of the 40 handle, the market fades it aggressively. You don't really see people flocking in to load up on upside calls or do anything that would signal maybe the worm was turning. Every chance they get, every near-term pop they get in WTI, they fade the heck out of it. And so far, that trade has worked pretty well. We're still hovering north of the 40 handle right now, listeners, coming into the latter portion of the show here. We're seeing WTI at about a 41.13. That puts it up about not even half a point, about 0.4 here on the week. So right at that 41 strike. So we are north of the 40 handle still. We managed to maintain it again so far this week, but only ever so slightly. Looking at where the paper is this week, it's in the SEP contract, almost half about 46% of the paper having gone up in the SEP contract. Vol out there up a bit, up about 0.75 of a point. So at about a 16.75 or so. So it's getting a little more frothy after the vol came in from those ridiculous highs of the apex or maybe the nadir, depending on how you want to view it there, of the debacle that was negative crude. The vol went crazy. Things like OIV broke. Now we're back to a little bit saner level around 16.75 or so. In terms of the skew, interesting evolution on the skew this week, listeners. The puts last week were bid, as they usually are, 6.4% rich to the at-the-money. This week, the puts are bid, 18.3%, so about a 3x jump in terms of juice to those puts, which kind of goes back to what I was saying before. People like to fade these rallies north of the 40 handle, and even Dan was just saying he thinks it's fairly priced in this 40 to 45 range for the foreseeable future. Sounds like this paper might be fading that even more aggressively south of the 40 handle. Let's see what's going on in the calls. Calls last week were 3.1% cheap to at the money. This week, the calls have come in even more. They are now 12.1% cheap. So pretty much rinse and repeat. Yet another week in the crude market, folks, fading the calls and bidding up the puts. Dan, does any of this surprise you, this skew action we're seeing out here in WTI this week, sir?
You know, Mark, I think it's right on target. The action that we're seeing in the skew really, to me, in this case, reflects the fundamentals. I know in my videos, for months, I've been talking about crude in terms of this dynamic. And so for us to go sideways here, for them to sell the rallies, which tells us something, that skew is a very interesting insight. It does say something about the attitude of people. It does say something when we get above 42. When you look at the candles the way I do, you'll see those lines above 42. And it means they're selling above 42. They're not buying above 42. So for those puts to react the way they are, I think that is reflected in also the price action that we're seeing. So I think we're doing what we should do, and that's basically stay in this $3 to $4 range for a while with the possibility if demand comes up. And what you want to watch is watch manufacturing in China. It's turning up a bit, but that's where we need to see that increase in demand coming from to really change, I think, this market.
Yeah, well, looking at this put paper, I'm not surprised that that the skew did what it did, because the number one with the bullet trade out here in this SEP contract are the 35 puts. They went up about 14,200 times. The lion's share actually Monday, 6,300 on Monday, 3,700 on Wednesday, and about 3,200 so far today. And a decent chunk of that, I'm going to guess, go out on a limb and say probably opening buying, even though not every day was not size opening, but definitely some buying paper on this because those puts are getting bid up. That put wing is getting juicy out here, followed number 2 by the 45 calls. So it's not all puts all the time, listeners. It's the 45 calls doing about 10,200 contracts. The lion's share actually today, 4,517 on the tape. All of that pretty much opening this week. So opening upside call positioning, just judging by the way the skew is shaping up, I'm guessing folks are dumping those and buying the 35 puts. But could be a little bit of in-between churn and burn action in the middle of the week out there as well. Let's just look a little bit farther down as we like to do here on the show, see if we see any weird or esoteric paper creeping in some of the larger, farther out contracts. If you go out to DEES, there's 50 calls trading about 6,700 times, so a little bit more upside on the tape there. And then we go all the way out to DEES of 2021, and it's 60 calls trading about 4,100 times. So if you like a little bit of upside, perhaps you're not alone. Given what we've seen in the other paper, probably some fading activity going on here. And Dan, we've come to that portion of the show. There's always so many products we want to squeeze in, but we always come up against it. We could probably make the show 5 hours if we wanted to, but we have to get the listeners on, Dan. So without further ado, it is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, welcome to your segment, the Futures Options Feedback segment. Let's see how many of you guys we could squeeze in. First up, we've got Walter. And Dan, you've been educating the futures and options space for some time, so I'm guessing you've answered this some variety of this question. Oh, I don't know, conservatively 17 million times. Let's see. Walter wants to know, I think futures options is a derivative of a derivative, ? Well, yes, you're correct there. So far, so good. He goes on, and futures trading, I know you only put up a portion of the contract's worth, but I'm confused as to its cash position, especially in commodities. Like, who owns the barrels of oil? And where are they going if the contract just ends in cash settlement? Did they ever even exist? I like that, a bit of a philosophical question. Or does the contract eventually end up with someone who actually wants the physical goods? Wow, a lot to unpack. Good question, Walter. I laugh because we enjoy the question. We're not laughing at you. We're laughing alongside you as we all discover this stuff together. But a lot to unpack here, Dan. I'm sure, like I said, you've answered these questions in many forms over the years, so I'll let you have pride of place. What do you want to say here to our friend Walter and his many questions, sir?
Well, you know something? I think Walter's question is very logical. If I'm not familiar with the futures market and I start looking at this thing, and as you said, he is right, futures option is a derivative of a derivative. And then he also talks about expiration, about cash positions. Let's take it in pieces. If you have an option on a futures, or let me before I say that, futures can be settled one of two ways. They can be settled in cash, a credit or a debit at cash, and the stock index option would be an example of that. When it expires, the option on the stock index, futures index, would expire the same time the futures, and you have a cash settlement. If you have a physically settled commodity, they have a tendency to settle before the futures contracts. And so what do you get at the end of a physically settled contract, like he mentions crude oil? You get a long or short position in the futures. That's what you get. And then you can adjust accordingly for the few weeks that you have to adjust that position. Now, let's talk about who does own this stuff. Where does it come from? Well, if you're a seller of crude oil and you're going to hold it till expiration, then you probably own it. If you don't and you go to expiration, then you're going to have to come up with that crude oil size of whatever you've sold. But here's what you want to keep in mind. 98% of crude oil futures and also the options as a result of that, 98% of the futures never go to settlement. They are always offset before settlement. Because why do people trade futures? Because they want crude oil? No. I have to tell you, I actually, last week or week before last, I dealt with a firm in South America. They hedge on the wheat market, soybeans, and soybean oil markets at the CME, very large size. Do they do that to get soybean oil? No. Soybeans? No. Wheat? No. They do it for price movement. A hedger is going to buy or sell futures or options because they want price protection. So that if I buy crude oil, if I'm a refiner, and we'll stay with crude oil. If I'm a refiner, and what do? I buy crude oil to break it down to gasoline, jet fuel, and all these other things. So the cost of crude oil is really important for my operating cost. So whatever I'm going to do in the futures, I do in the hedge. I would buy crude oil futures. Now, let's say crude oil goes from $40 a barrel to $50 a barrel, went up $10. My cost of doing business just went up $10. But if I bought futures or I bought calls, enough to go delta neutral, at that point, I got $10 of profit in my option or futures contract because they're totally correlated to the cash market. So I paid $10 more, but I made $10 in my hedge position. So that's what they want. They're not doing it to get crude oil. So I have to tell you, I don't know any institution I deal with. Gosh, so there's a company out west I can think of too, agricultural company. They buy and sell thousands of contracts at a time. They don't do it for the underlying product. So majority of the trading that you see in futures is for either hedging, or a speculator. A speculator is trying to lock in a profit. So in this case, if we think about where does it exist? Yes, if you're a seller of crude oil, typically, now what would happen, let's say I'm a buyer and you're a seller, and we're now at expiration, that's when ownership transfers. And what I would get is I would get some documentation from you that shows that you own 1,000 barrels of WTI, West Texas Intermediate crude oil, in a storage facility. And in this case, it's going to be Cushing, Oklahoma. That's the delivery point. And I give you money, and you give me that receipt for that ownership. That's the process. But remember, it rarely happens. It's only less than 2% of the time. So that's how it actually occurs. You don't get 1,000 barrels in your front yard. It's being stored in some facility that you're going to get a warehouse receipt, and you pay for that. You actually have an exchange of ownership.
Yeah, it's funny. People have this nightmare that they touch they touch futures options, let's say crude, that all of a sudden the truck's going to show up on their front door and just start dispensing crude all over their lawn. It's not how it works there, Walter. Great explanation there. Dan, yeah, if you're concerned about such things, as Dan laid out, you have the option, pun intended, to close it out. You don't have to worry. So if you are trading a physically settled contract like WTI, you can just close it out before expiration. You never have to worry. You never have to worry about such things. And there are cash-settled products out there in the commodity space and others if you prefer that type of trading as well. So the notion that you're going to hit the buy button on your broker and the next thing you know, here comes the truck. That's not how it works. But good question out there. Great to everyone who wrote in. We'll get to more questions next week, I promise. There's a lot to parse on the show this week. And Dan, you did an able job holding down both hot seats, the FTSE Russell hot seat and the CME hot seat. So I think you've earned a little bit of a plug, sir. So if folks are interested, they want to check out your daily videos or maybe reach out to you to see what you're working on the capital management front, where should they go? What should they do?
Just dangramza.com. And there's a free video that if you want, you can put an email in there that you'll get a notice every day when it's published. The intent behind it's 21 markets. The intent behind it is just to give you an overview of what someone's thinking. You'll see red and green lines, which represent buy and sell levels for me. They're not trade recommendations, but it's to take you through the thought process of how someone approaches these markets. So that's the intent behind it. And filling Sean's shoes that was a big, tall order. But it was great being with you, Mark. I really enjoyed our session today.
We'll be back next week. We'll have to get you back on, Dan, when you could catch up with Sean a little bit here on the show. Check it out for yourselves, listeners. Dan Gramza, GRAMZA.com is the place to go for all this kind of analysis he did on the show here in a lot more detail and a lot of fun products. DanGramza.com is the place to go to begin your adventure. And, of course, he mentioned our buddy Sean. Check them out over there. FTSERussell.com, FTSERussell.com. Give him a follow on the old Twitter while you're at it as well. At FTSE Russell is the place to go. And, of course, our friends over there at CME Land. You can head on over there. CMEgroup.com/TWIFO or /TWIO is the place to go to get these reports for yourself. Remember, they're free. So if you're someone like Walter and you're kind of confused about how these work, you want to see what's going on in the options market, what's going on, the vol and the skew, all this data is there for you to use for free. So I've said it before, I'll say it again. If you're trading these products and you're not using this stuff, I honestly don't know what you're doing, because there's literally nothing else like it out there. So check it out. Begin your journey for free. CMEgroup.com/TWIFO. Then you can always upgrade to the full kit and caboodle if it meets your needs out there. And of course, on behalf of Dan and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for sending in those questions. Keep them coming. We love to hear from you. And we'll see you back here tomorrow, 1 p.m. Central, for Volatility Views. And then it kicks off again on Monday with the option block all the way through to Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.